We've got some fresh new young talent doing some things that I know you haven't heard before.
1, 2, 3, listen.
Welcome to Finances, your home for all things financial, investment, money and lifestyle. Hosted and curated by the very talented team of certified financial planners, Burke, Britton Financial Partners. What do you think the future of insurance is with like the application for insurance? Do you think that it's going to be something that just becomes a specialist area that you just have you go back to just having an insurance agency only that deals with life insurances, or that people are going to get pushed to do it themselves?
I don't know, because it's hard, because the complexities where it's not necessarily hard to work out how much cover you need, but then where do you own it and with what provider is difficult.
Yeah, and then getting it. And then actually getting it, subject to
I had one last week. She had IBS, and she disclosed that at her work, she works in an office environment. She said, "Look, I get a stiff back because I sit so much. Like, I'd just go to the physio once a month or once every 2 months just to keep it sort of proactive." So she disclosed that. She did not pre-assess it. Did it in the disclosure. Came back with a back exclusion. Came back with the IBS flagged as an issue and vertigo, full decline. She cracked it big time because she said, "I'm fucking healthy. Like, I don't really have anything wrong with me."
It's kind of fair enough for people to crack the shits about that, particularly when it comes out of left field. And like for most of those conditions, like the stiff back or something,
even IBS, like
someone's dealt with it forever.
She flicked the stats at me and said 1 in 5 Australians have it.
Yeah.
She's not medicated, just dietary, just monitors her diet, manages it fine. Doctor said no need for anything further, but they still flagged it as an issue.
I think one of the issues with insurance is that it's kind of an afterthought for people. Like it's not a high on the priority list, and you understand why, because people don't want to talk about, death or dying or insurance because you're paying for something you hope you never claim upon. But if in a perfect world, what would you would be telling people what? You'd be telling people, listen, as early as you possibly can, you kind of got to work out what insurance you need, and sometimes preemptively understand what you're going to need, and then understand that the insurance process is a difficult one. And like I think about with the level of sort of mental health and anxiety of kids coming through even high school, like they're all going to have on their record, their medical record, that they've got social anxiety, they've got
it's going
depression.
to come to a head at some point of what happens with insurance. Like how, I don't know what it is. Like there's going to get to a point where you can't just have every policy excluded, but at the same time, all of these automated cover providers are going to start getting burnt because they're going to get claimed on.
Yeah.
Like that's the thing is, if we look at a client
when
now,
you mean the automated cover,
so
you mean like likes of the industry,
because
default cover.
Yeah, because if I just set up an Australian super fund next week and transfer $200 into it, I'll probably get 150 grand of life cover, TPD, bit of income protection maybe, without any process, and I could be crook as a dog and know like I'm at high risk, I couldn't get cover elsewhere. So even though that cover's probably relatively cheap, it's got no exclusions, and I'm a fair chance, I'm a high risk for them of claiming on it. When do we get to the point where that tips over and they don't do that anymore? Like, where did it even come from to start with?
The automatic insurance?
Yeah. Like, at some point, they're going to go, why are we doing this?
Well, I think it's a bit of probably a loss leader, you'd call it, where they take a hit, they've done their maths, and there's probably a tipping point where the claim volume on those policies becomes such that they go, oh, we can't do this anymore.
Because in the past, we would have more often than not, client comes in with some automatic cover, we find them some cover elsewhere that's maybe better price, clean terms, roll over, cancel the old cover. Now it's almost 2 in 3. You keep what they've got, and then you just add some top-up cover elsewhere. So now there's going to be more people than ever actually retaining those insurances long term.
There's going to be many more people with multiple super policies.
Yeah, and multiple insurance policies.
Which also, you run the risk of people with multiple insurance policies, the opt-in rules, like people forgetting or not making a contribution and losing that cover. Maybe that's the real message here, is that for people that even though they're not getting advice, you should treat your insurance that you've got as golden, particularly if it's got no loadings or exclusions on it. Sometimes, I suppose, if you haven't done any underwriting, like people say, how do I know if I've got loadings and exclusions? Well, you would know because you would have applied for it. If you didn't apply for cover and you've got it inside your super, it's going to be without loadings and exclusions, and it's probably there's got to be a compelling reason to change it.
Yeah, and something you said before about, I've had a client recently where they're young, early 30s, healthy, got some debt, but like realistically, they got no kids or anything at this point. And you look at them as they stand at the moment, and if you said they might need 500,000 of cover, and if one of them died, it'd clear enough of their debt, leave them with some modest debt. The other one would continue to work. It's all good. That'd be fine. That's probably all they need at the moment. But if they plan to have a family in 4 or 5 years' time,
upgrade the house,
anything
borrow
like
a little
that,
bit more.
Do you preemptively take the cover and essentially over-insure in the short term? Or do you carry the risk of not having cover and then apply for more in 4, 5, 6 years' time?
Historically, I would have said, we'll get the cover when you need it. More and more now, I'd say, are you in good health now? Is it within, or can you afford it? Is it detrimental to anything else? And I know it's difficult from a compliance point of view to justify that.
And for the client, like,
yep.
They don't go, whatever. Yeah, I don't want more cover than I need. 500 grand, I'll get by.
Yeah.
It's a lot of money.
But knowing how quickly things can turn south, I mean, I don't think I've spoken about it on here yet, but the skin check, melanoma, this year, I've gone from no issues with ability to get insurance to pretty much not getting any insurance.
Yeah.
For a while at least, maybe not ever. If I run the gauntlet because I go, I'm healthy, I'm fit, and I'll just get the insurance later. And, for me, I probably have always preemptively, I needed to because there was always another kid coming. So always had to plan for protecting the family. But now I think, well, lucky I have preemptively put in place insurance that I've got because I'm not getting any more of it.
Once you've got it, you control it. That's probably one thing I'm big on with the client. If you've got it, then you keep it as long as you pay it. So you can always decrease it.
Yeah.
So we almost go, my approach for a lot of people has been go for the optimum level to start with, go for the top end, knowing we control it. It's on our terms.
Yep.
And then we can just bring it down. Or, again, this is where it gets detailed and why I think insurance won't be something people ever do themselves is, okay, I'm going to take $1 million of cover. It's probably a touch under, but I've got indexation on it and I'm going to ride the indexation up. And then when I get to the point where I don't need more, I can turn the indexation off. And then I can start to decrease it. So you got levers for cost control.
Have you ever used the future insurability options on policies?
I think I've got a couple that have got it, but I haven't triggered it. I don't think. But again,
so you pay a premium now for the ability to be able to increase your cover by say $100,000 if you have a child, or $500,000.
To be honest, I think one of the things I hate about the insurance is all of those things.
The bells and whistles that confuse people.
It's too confusing.
It's like
it should be
private
simple.
health cover where you go, I can't even, like even on the comparison sites, good luck actually comparing like for like.
They're not like, none of them are. That's where insurance, I think, and I get annoyed, they come in and do a presentation to us and explain all the new fancy things they've added onto it. And I go, I just want you to just all provide the most basic, simple, streamlined, like for like cover.
Yeah, no diversion tactics.
Because they're just trying to get they're one-upping each other on features, which 99% of actual consumers, people on the ground don't care for. Like I just want simple. Indexing is simple. Like you go, every year it's going to go up by X percentage or by CPI. Yep, that makes sense. You can turn that off if you want to. It'll be a bit cheaper. Easy, simple. When you go, but if you get this and then you can buy back this bit, and you can add another bit on here. And if you have a kid, we'll be able to bump it by 20% of your base starting, but that doesn't include the indexation. It's just from the base. All these things.
Partial claim options, super guarantee contribution options. Financial planning.
We start sounding like boring old financial.
We do, but it's weird because it's such an important part of what we do, yet it's probably one of the most painful things that we do, and it's probably one of the least appreciated things we do from a client perspective because you only really get the benefit of it at the worst time in your life. And like if we interviewed some of the multiple clients that we've had that have had insurance claims, they would advocate it as probably the highest priority thing that they've ever done. But that's because they've actually gone through the process of either losing a loved one, being disabled, having a trauma claim, being out of action from work and not having an income. I'm not sure what the answer is to it other than trying to educate people as much as we possibly can about the importance of insurance and also the fact that it's preemptively letting them know that it's a difficult process, and pre-assessments, even though they take a long time, are a worthwhile thing to do. And you should always, if you're doing a medical pre-assessment, you should always just disclose everything. It's just a pain in that. Like if you think you're going to hide something or have it not unearthed, don't. It will.
Because essentially they just go straight to your doctor anyway and say, verify all this. And the doctor's they're not going to care. They're just putting the truth out there. So they're just going to tell them what's real.
Yeah.
Come undone quick. Or worse, it doesn't get picked up. And then you claim on it in 15 years' time, and the insurer goes, can we just double check there was no issue on the outset? And they go to the doctor, and the doctor says, no, I knew about that 2 years before then.
Non-disclosure, no claim.
Yeah,
and you've paid premiums for 15 years.
Another thing, I think, again, this is where insurance is confusing. I had a good conversation with an underwriter yesterday, though, about this. We were talking about it. When you get an exclusion, immediately you just think, oh, that's everything. Like, I'm done. On spinal exclusion was what I was talking about with this underwriter. And he said, no, just to be clear to the client, I want to make sure they understand this. We've assessed her as having back stiffness and soreness due to her work from being in an office environment. And what we're saying is, if due to her work in the future, that gets to the point where she can no longer work due to that, we're not going to pay a claim. If she walks out in front of a car, gets cleaned up, or is in an accident, breaks her neck, we're good to pay.
Okay, but what if they've excluded?
No, so that's what they're saying. So they're saying it's only in the line of your work. So
what does the exclusion actually say?
So the exclusion says that it needs to be from, get the right word in, degradation in line of work, not from an alternative.
So the exclusion
injury.
Actually says that specifically.
Yeah, that's where he said that's. I know. I said to him, "Is that normal?" I still sound like an idiot, but I think that's the way that some of the insurance companies are trying to go. We're going to come to the party here and go, all right, you're a tradie. If you've got a bad back from shoveling dirt all the time, we're not going to pay you in the event that that's what causes you to not work. But if you're on the weekend doing another activity and there's an accident, like something that's not related to your line of work, not related to that existing injury, but it's in the same area, like say you're cleaned up and your lower back, you've got a bust and you can't work, then they're now going to start including that as still a covered item, because there's no link. Like, that's just a freak event.
Yeah.
So that could have happened if I had a good back, you had a bad back, you get hit in whatever circumstance, then you still would be covered.
Yeah.
So again, we've got to be careful with exclusions that we don't get spooked by what they actually are too on the surface.
Well, one of the things that we probably could do even better with exclusions is always question them. So one of the things before we go back to clients I like to do is to say we have an exclusion, is to go back to the underwriters and say, well, explain to us why exactly, like, has there been any misunderstanding about that injury or illness? And secondly, what can the client do in the future? So if it's a BMI issue, how long, like in 2 years, 3 years, in 6 months, or in a weight range, can they revisit that exclusion? If it's back related, is there a period of time, 1 year, 2 year, 3 years, if they're symptom free, where they can have that removed? So rather than just accepting exclusions on a blanket basis, actually looking at...
I think that's where, again, we probably undersell ourselves. Like, I had one recently where I did a pre-assessment and it was all disclosed, and the pre-assessment said, all good, understand the issue, but we're good to go with it. Went through the process, disclosed the same thing. Underwriter came back and said, not going to cover it. Went back to the insurer and said, here's what you said. And they said, yep, fair play, we'll honour it. And pushed it through. But if we didn't ask the question, we're just going to throw our hands up in the air and walk away.
So you went back to the original pre-assessment where the insurer had said that we would
cover for that event, and she disclosed the exact same thing as she had in the first instance. So by being honest at the outset, got us a clear pre-assessment, then used the pre-assessment to justify why they should overturn it, and they said, yeah, we'll honour that because we did say that.
Yeah, so here's the reason why. Like, some would argue that if we're doing insurance advice, it's a costly exercise. We charge for providing insurance advice or providing financial advice, but that preemptive work, which there is a fair bit in it, to actually do a full pre-assessment, send it off to multiple underwriters, it's worth its weight in gold. Like, it's worth its weight in gold to be able to go back to that and say, this is what you told us you would offer. And so for anyone out there that's thinking about insurance and thinking, well, I'd rather just do it myself and just run the gauntlet with underwriting. There's value in actually getting advice. There's value in actually doing a pre-assessment, which is an anonymous health declaration that it's not 100%, but it gives you a very good indication about whether an insurer is actually going to give you cover or not.
Can save you a lot of time too.
Yeah.
If you do the pre-assessment and every insurance company goes, not a chance, then you can reassess and go, look, unless you do X, Y, and Z, we can go back to them and ask more questions. We can save everyone a lot of time and effort rather than go right down that path, go through the medicals, do the questionnaires, all of that. The other thing you said before about going back I always go back. As soon as there's an exclusion, even if it's expected, go back and question it about what to do next. Because I had one and I always called my process in my mind, not sure what you do here, but you get the exclusion, go to the client, speak to them about it, get some context to it, go back to the underwriter, and then use that information to sort of go to battle and see if you can overturn it. I had a really simple one probably 3 or 4 years ago. I did the pre-assessment, no issues, went through the process, bang, back exclusion. On the surface, I go, she obviously didn't tell me something about it. Called her, spoke to her, she goes, I told them I get a sore back when I've got my period. So I said, all right, I'll go back to the insurer. So I went back and told them, they said, oh, yeah, we did, that's what she said. I said, well, it's crap. So they said, oh, if your doctor writes a letter to just verify her take on it, we'll be all good. Went back to her, letter signed it. Doctor wrote a letter, sent it to the insurance company, wiped the exclusion, and she was all good.
You see there where the insurers are pretty sneaky.
That's why I always push back.
So they're pushing to mitigate risk. Their first call is to go, okay, well, there could be something underlying here. We'll just put an exclusion on it. If they accept that we cover ourselves, maybe we reduce the overall risk, you've got to push back. You've got to push back and say, this is unreasonable. And like you said, if it means you've got to go and get a secondary report or opinion from a doctor, then you should do it. Again, that's why insurance can be painful. It's painful, but it's important. It's a key part of what we do, but you'd probably agree that it's easily one of the most painful things from an advice perspective because there's so many variables.
The other part is that not many people come in off the street with a clear goal of doing it. So,
they haven't really thought about
So again, we have to put our hat on to explain to them why it's important, but it's not. I think you said it's not sexy. Like it's just it's one of those boring but essential things that we need to have, and it lets you do other things with more comfort, like investing and taking on debt and starting a business or taking on risk. Very rarely do I have someone come in and you go, oh, why did you come in? What was the
to get reason? Insurance?
Yeah, last night it happened, and I nearly fell off my chair. And you sort of go, okay, well, good. You almost go, well, that's a staple. Like they're good. They understand that part. You even spend less time talking about that in that meeting because they've already come in, they understand why they need it. You run through scenarios. Then you can talk about all the more positive stuff and talk about investing, growing wealth, and how they could self-insure through wealth generation and creation. So
what would be the thing that you'd want? So if you could have a client walk in and be understanding and educated about insurance, what are the things you actually want them, ideally, you want them to know when they walk in the door? Well, what are the kinds of things that you already want them to be sort of over the top of so that you don't have to start from the ground floor and explain? I'll start. Mine, the thing that shocks people when you first tell them is the sum insured. Most people, when you talk about insurance, they don't factor in the fact that if you don't exist, your income doesn't exist. And if you've got a family, so if you're like me and you've got 5 kids, a wife, and I'm
a
not
dog and a cat, 2 dogs and a cat,
2 dogs, a cat, and a business. If I'm not here, then my income doesn't exist. I'm 44, maybe let's push it through for another 20 years until I'm nearly 65. There's 20 years worth of my income every year that doesn't exist. I've got kids that go to private school. I've got dogs that need to go to the vet every 5 seconds. And I've got a wife that likes the lifestyle she's accustomed to. So how do we put a dollar figure on that? And that dollar figure sometimes is
lots. And that's definitely one of the things that most people generally think a couple of $100,000 of life insurance is a lot of money, because $200,000 is a lot of money, but $200,000 of life insurance is not a lot of money in the event the person generating even $50,000, $60,000 a year doesn't exist anymore.
What's the median salary in Australia now? Is it something like
75? Is it something?
Okay, so maybe it's 3 years worth of income just.
But what's the median debt level? So if you go, right, let's say that as a hypothetical, they've got $600,000 worth of debt. They just covered debt. So you go, well, I'll leave them without a mortgage. That's probably the cliche lies. Or we'll cover our debt. You probably want to cover at least your debt as an absolute bare minimum. And where maybe cost is a factor, that's something you have to factor in. You carry a bit of risk because you choose to just cover debt. But then you need, I always say, it just buys you time. Like anything on top of that just gives the people who are left behind time to work out what they're going to do. So I don't necessarily always agree with a full income replacement for 20 years, but if there's enough there to give them 10 years of time to work out everything else around it, so there's a business, it doesn't just turn into cash the next day. It gives them 10 years to work out what happens with those assets or whatever it may be. There'll be things that change in their lifestyle. 10 years, Carrie will find another husband. She won't be.
He's not getting shit. I think testamentary trust is on the on our list of discussion points. We might float again.
It's just about finding time to do things and just take stock.
Yeah,
and that you need a long time to do that too.
Particularly if it's just post, the loss of someone. The last thing that someone wants to be doing in the grieving process is thinking we're going to have to sell assets.
Yeah.
We're going to have to liquidate stuff. We're going to sell our house.
Because the other cliche thing is we'll just sell the investment property and clear the debt. Oh yeah, that's easy. I say, you want cash today or tomorrow? Like how quick can you get access to that? What's the tax implications? What's the market doing? What's all these things? It might not be that you cover the full debt on an investment asset. Like I'm sort of to and fro on that, but you might say you cover half the debt, and worst case that goes and sits in that loan and gives you 5 years of time, 10 years of time to work out when. So you go, right, I'm going to cover half the debt on all my investments, all my home debt, and a buffer to give my family 10 years of income replacement as an example.
Yeah.
Potentially. I think sometimes we get too generic where it's just all debt. It doesn't need to be all debt. It doesn't need to be 30 years of income replacement.
Yeah.
The challenge is on the other side when you're and thinking of clients recently where they're both young, sort of late 20s, early 30s, no kids and debt. And for them, if you play it out at the moment, sort of say to them, what would happen if he's not here? What would happen if she's not here? If there's $500,000 of cover, leaves them with $200,000 mortgage and they can still run their business or do their job. They've got no kids that pulls them out of the workforce immediately for care or anything like that. So they could, and they're young enough, they're probably going to recouple. Like they're going to find someone else later. So they go, well, that's fine. We're good. We don't want any more. But then you go, right, with 2 years' time, you're going to have kids. So if he passes, she's now not working, looking after the kids. Now you've got no income. So now you've got $500 to cover, which buys you still got $200 of debt and no replacement. So quickly changes. So then you go back to that. Do you do more early or do you wait?
Yeah, it probably ends up being somewhere in the middle. Like it probably ends up being somewhere in the middle. You kind of split the difference, have a foot in either camp. Like most things in our world, we're kind of mitigating risk in investment, also mitigating risk with insurance and protection. So anything else you'd want people to know before they come in around insurance?
Good question. It's just all about open. You need to be open and honest. It's not like going and insuring your house or your car. It's personal. I think that's probably, we've got better at that, is actually setting people up to go, look, this is going to be a little bit invasive in terms of the questions you're going to get. And again, be honest about it. You just got to be open.
That's probably one. Yeah, we end up sort of wearing almost a medical hat for with some of the questions we ask people. Go, what are you asking this? I'm come to you as a financial advisor. Yeah. Yet we sort of encroach into the medical space, which if you could prepare people before they come in to the fact that, well, I mean, we don't have to. You don't have to disclose if you don't want to, but it certainly makes it more difficult if you're not willing to actually share your history.
I suppose with that again, it's your history. It's your family history. Like, again, for some illnesses, disease, whatever it is, that they know are hereditary, it's really important.
Mother, father, sister, brother.
Yeah, it's all of those people. So a few years ago, I had a guy who his mum died from MND, and that was a really complex process because every insurance company looked at it differently. So some said we would exclude for any illness to do with the brain or anything like that. Others said, and it depended on what age his mum got sick, how long she suffered for, and when did she pass as well. So you had about 6 different providers with differing views on it because realistically none of them really know too much about MND, like it's still being researched. We end up finding one that covered him fully, completely, and we end up getting him the cover he needed, thankfully, because he actually ended up needing to claim on it later on. So again, that process at the time felt a bit tedious, frustrated him, but in reflection, it was very important. Again, probably just reassured more for us internally why you do that.
Yeah, I had one with, I think it was a father with MS, and I think we went to multiple insurers, and most of them wanted to offer an exclusion for all diseases of the central nervous system, purely because the father had MS, and I think it might have been MLC that ultimately ended up just offered an exclusion just for multiple sclerosis alone for that client. Again, it was a process, take some time and effort and energy, and not taking the first response you get from an insurer or an underwriter as the final call. You got to kind of keep pushing, which...
Yep. It's very hard to do that. Again, not to sort of beat our own drum here, but it's difficult to do that just an everyday person on the street. You don't get the connections we've got in terms of underwriters, scope of insurers to look at, systems to make it easy to do that. Like, if I wanted to just go and apply for it myself, it would be difficult to do. Like, I even needed to use our own internal systems and resources around us to help to do that. So
I reckon that's one of the things that's not very well conveyed to people, is the value that's added, because that can be sometimes the shock for people, is that we charge, I said before, that we charge for the advice that we provide. There's legitimate value in actually paying someone who's got the expertise to do the pre-assessments, to do the back-end work for you, to negotiate with underwriters. And sometimes people have to go through that process, the painful process, to realise, that's what you've got to do. For me to get the insurance, that's what I've actually got to do. If you're fortunate enough to have done it yourself and you're a clean skin, meaning no medical issues, and you got your insurance straight away, good on you. Well done.
It's simple as sometimes it might be. Let's say we charge $3,000 to do an insurance review and research piece. Client on their own didn't choose to get advice, rang MLC as hypothetical, Astron, whoever it may be. She might be an office worker, he's a tradie. You put it all in place immediately and the premiums come out to be $6,000-$7,000 a year. We look at it and you might work out there's two completely different insurers for them both, one that's suited to tradies and one that's suited for her being an office worker, which would be deemed low risk, and their total premiums might be $4,000 a year ongoing. So within 1 year they've paid for it, plus every year after. So again, that would be a genuine situation. As generic as that sounds, that's legit, that insurance companies are set up to deal with different occupations.
And that's just value added on a premium basis. And that's add to that if there was other quirks or anomalies in terms of health that need to be negotiated as well. Where we think about loadings, not exclusions, but loadings, where someone just accepts a loading, which is an increase.
What's a loading?
What's a loading? So a loading is an increase in the premium. So if the quoted standard premium is $1,000, but you have a 50% loading, then they're paying $1,500 for that. Now, if the client or the person accepts that, thinks, I can't negotiate that, or I can't look at alternative providers.
Or I can't change it. I suppose the other thing from our perspective is I've had clients who load, probably the easiest, most simple loading, and two of them probably BMI, so your weight and smoker status.
Yep.
And you go, okay, you are going to get a 100% loading, which is pretty common for smokers. But they go, look, I'm in the process of getting off them. I'm 6 months into it. What they need to do is go, right, we get through 12 months. We're going back to that insurer. You've got 12 months as a smoke-free status. You can clear that 100% loading. So you've got to be aware that you can go back and it can get better. Like you can go back and actually ask questions. Same with the BMI. You lose weight. You go back to them and say, I've retained this weight under my BMI is now 29 or whatever it needs to be. They will then go, okay, well done. We'll reduce that off there now. And you've got to, but if you don't know, you just pay for it forever.
Have we done insurance to death?
Yeah,
now?
This is good. I've got it off my chest.
We hope you enjoyed today's episode. If you're keen to understand more about how financial advice could benefit you, follow us on Instagram, Facebook, and Twitter at Burke Britton FP, or Google Burke Britton Financial Partners. Check out our client reviews, testimonials, and make a time to meet one of our certified financial planners by clicking Book Now on our website. Thanks for listening.
Any information contained in this podcast is of a general nature only. No account was taken as to the objectives, financial situation, or needs of any particular person. Therefore, before making any decision, listeners should consider the appropriateness of any information with regard to their particular objective, financial situation, needs, and seek independent advice from a licensed professional specific to their circumstances.
All right, hit it.
That translates to don't be a moron and act on what some random person says on a podcast. Take personal responsibility. Do your homework. Ask questions and speak to an actual human that knows what they're talking about before you do anything. PB Financial Solutions Proprietary Limited, trading as Burke, Britton Financial Partners, are authorised representatives of AMP Financial Planning Limited, AFS, licence number 232706.